Hello everyone, this is Jesse Kovacs from Kovacs Wealth Management, coming to you with an educational economic update for March 2017. Now in this month's video, we'll discuss some of the major headlines that influenced the financial markets in February and provide insight into what these developments can mean for you as an investor. Please make sure you stay tuned at the end of this video for a required disclosure statement. Now February 2017 was a month filled with record highs in the domestic markets. The S&P 500 and the NASDAQ both hit a number of new highs last month. Now, while the Dow set on a record-busting streak, in fact, after reaching 20,000 for the first time ever in January, the Dow hit record highs every trading day between February 9th and February 27th. Now, the last time we experienced a string of records like that was in 1987, and this is only the second time it's happened in the past 120 years. Now, seeing stocks rise like this can be an exciting experience, but I want to caution you not to get caught up in the euphoria. Now, just as emotion has no place in investing when the markets are volatile and changing, the same rule applies when markets are growing. So let's dive a little bit deeper and review some of the fundamental data we learned in February to better understand where the economy stands right now. On the labor front last month, it gave us somewhat mixed data. We received the January jobs report, which showed that the economy added far more jobs than most experts and analysts predicted and continued its 76th straight month of growth. But on the other hand, hourly earnings and labor force participation each increased by only a small margin, while unemployment was also slightly up as more people entered into the workforce again. Now, ultimately, the job data released in February indicates that the labor market is growing, but the pace is still not what many people would prefer. Now, another area where we saw modest growth was in the revised GDP numbers for the fourth quarter of 2016. Now, each quarter, the Bureau of Economic Analysis calculates the U.S. gross domestic product, which is the total dollar value of everything that the people and businesses produce during that period. Now, this measurement is a critical indicator of our economy's health. So investors and financial analysts watch these changes very closely, and because the Bureau receives updated data after the quarter ends, they release 3 GDP numbers over the course of 3 months. You'll have the advanced, preliminary, and final numbers. Now in February, we received the second, or the preliminary reading of GDP for the fourth quarter in 2016. Now consensus was that the reading would increase to 2.1% from the 1.9% growth in January's advance report. But in reality, the reading didn't change and stayed at 1.9%. For comparison, the third quarter GDP came in at 3.5% growth. So rather than indicating that the economy is slowing down, however, just one aspect of GDP contributed to the most decreased growth, and that was lower net exports. Now, lower net exports at the end of 2016 was one of our lower problems. Now, trade is integral to our economy, so maintaining a healthy trade balance is key. As the political environment evolves, changes to trade deals could affect this balance as a result, and our GDP. For now, no one can say what new policies may be on the horizon or if the markets will continue to reach even greater heights. So we will continue to analyze the data and search for the most thorough view of our economic standing. This perspective is the foundation of our support, and we are here to help you find a clearer perspective amid the hype. Well, that's it for this month's educational economic update. Once again, this is Jesse Kovacs with Kovacs Wealth Management, signing off for the month of March 2017. Please remember that nothing we talk about here is a recommendation. If you would like to discuss your personal financial situation with us, please give us a call at the office at 732-818-1278. We're happy to talk to you. Take care.